Here in this section, we're going to talk about how to trade triangle chart patterns. We're going to talk about the three types of triangle chart patterns, which are the symmetrical, descending, and ascending. We're going to start out here with the symmetrical triangles. A symmetrical triangle looks a lot like a pennant, but there is a difference. The difference is that a pennant is a continuation pattern, so the market continues to go in the same direction after the pennant is broken, and there's always a strong move before the pennant is formed, kind of like in this picture. So you can think of a flag with the pole here. So it's got to go strong move, then form the pennant, and then it continues in the same direction. A symmetrical triangle, on the other hand, does not have a big move before it forms. So it's kind of like the flag without the pole, and it can also break either up or down. A symmetrical triangle is formed when the slope of the line that connects the price's highs and the slope of the line that connects the price's lows come to a point where it forms a triangle. So you can see right here, we connected the highs, we connected the lows, and this forms a symmetrical triangle. What this means is that the market is in a point of consolidation and that neither the buyers nor the sellers are in control at the moment. You can also see here we didn't have any big move before this triangle formed. The market kind of came down, market came back up. So there wasn't some strong move down or up in a certain direction before the triangle was formed. Now, what this means is that the market is in a point of consolidation and neither the buyers nor the sellers are in control at the moment. Then as the candle gets closer and closer to the point where the two lines come together, we're getting closer and closer to when the breakout is going to occur. We're basically just waiting to see whether the buyers or the sellers are going to take control, and then we can go along for a ride as the market breaks out and moves either up or down. Once we see that breakout occur, whether on this side or on this side, we can enter in on the trade. In this example, the buyers took control and the price shot up. You can see the distance of the triangle here is about the same distance as the move up here. So this would be a good place to set your take profit. So if the price can either move up or down, how can you make sure that you catch the move, whether it moves up or down? Well, what you can do is setting up for this, you can set a buy stop here and a sell stop here. So whether the market breaks out this way and moves up, it's going to activate your buy stop, or if the market shoots down this way, it's going to activate your sell stop. So in this case, you would have had a buy stop and you would have opened the buy right here automatically, and then price would have shot up and you would have been in profit the whole time. Then of course, for a stop loss in this example with the buy stop here, once you get into that buy trade, you can put your stop loss below the triangle here, because if the market moves back down this way, it means it was probably a fake out. And vice versa, if you were in a sell stop here and the market came down, your sell trade activated here, then you could put your stop loss here above the triangle, since if the market moves up, it probably means as well that that was a fake out and you should get out of the trade as soon as possible. Moving on to the ascending triangle pattern. This pattern is formed when there is a resistance level, as you can see up here, and then higher lows right here that form a triangle. The resistance level tells us that the buyers can't seem to push past this level, but we can see with the higher lows that they're gradually pushing the price up. So the question is, will the price be able to break that resistance level right here and continue up? Or is this resistance level going to be too strong and is price going to get rejected and bounce off of it and go down? Well, the answer to that question is that really either could happen. Most of the time it will break this resistance level and it will continue up, but there are plenty of times when that resistance level does in fact hold strong and the market bounces off of it and goes down in the other direction. So what we can do is prepare for both and set a long order here above, so a buy stop up here, and a sell order or a sell stop down here below the triangle, so that if it bounces off here, that means that you're going to open a sell down here. If it breaks through resistance, you're going to open a buy up here, and you're going to be in a good position. So let's see what happened in this example. Look at that. Looks like the sellers took control, bounced off of this resistance line, and shot down this way. You can see here as well that price dropped about the same height as the height of the triangle formed over here. So that would be a good place to put your take profit. And even if this had gone the other way, you of course would have had your buy stop, which also would have been activated, and you would have been in profit if it shot up the other way. Now at this point, since you got into your sell, you could have put your stop loss up here above this in case the market shot down here, but then faked you out and moved straight up this way. You would have been stopped out here and not lost as much. So that's how you can trade the ascending triangle. Moving on to the descending triangle pattern, this is going to be the exact opposite of the ascending triangle pattern. A descending triangle pattern is formed when there's a support level, like you can see here, and then lower highs that form a triangle. The lower highs tell us that sellers are gradually pushing the price down, but they can't seem to get past this support level. So will price be able to break that support level and continue down? Or is this support level going to be too strong and is price going to bounce off of it and shoot up? Once again, the answer is it could be either. So most of the time, price is going to break past that support level and continue down this way, but there are definitely plenty of times when that support level doesn't hold and the market bounces off of it and goes in the other direction. So just like with the ascending triangle, we can prepare for both by setting a buy stop up here and a sell stop down here, so that if the market does come down this way, activates a sell. If the market goes up this way and breaks out this way, it's going to activate a buy order. So let's see what happened in this case. In this example, the support line also held up. So the buyers took control, it bounced off of that support line, and it shot up this way. You can see here it went about the same distance as the height of the triangle here as well. So you can put your take profit here. And then, of course, you can put your stop loss in this example, since you're going to buy, put a stop loss down here below this descending triangle in case it fakes out and goes down this way. So you're stopped out as soon as you can. So hopefully this helped you out and you can see how you can trade these different triangle patterns that you can find in the market. And this can help you to get in on those breakouts before they happen and you can catch all of that profit. So I'll see you in the next section where we'll wrap up this module on all the different types of chart patterns that there are in the market.
Hey, thanks so much for watching. Make sure you join our free Discord channel to get access to all the cheat sheets and a bunch of other cool bonuses. The next video in the course is right here.